Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenevec on Bloomberg Radio.
Mark Zuckerberg taking the stand in federal court today as the first witness in the U.S. FTC's antitrust trial seeking to break up Meta platforms. He's the company's founder and CEO, of course. He's set to face questions about Meta's acquisitions of Instagram and WhatsApp. The FTC is seeking to force Meta to divest those platforms, alleging the acquisitions gave Meta an illegal monopoly on portions of the social networking industry. To that, here's FTC Chair Andrew Ferguson earlier on Fox outlining the case.
Here, we have actual evidence that the transactions turned out to be anti-competitive and have given Facebook and Meta a tremendous amount of power. We certainly think it's a monopoly, and we think that the evidence that we're going to put on at trial is going to show that it's a monopoly. And look, we all saw full on in 2020 how much power these social media platforms have over every aspect of our daily life, of our politics, our elections, our social lives, our economic lives. And that's what this case is about addressing that sort of power and making sure that 2020 can never happen again.
That was FTC Chair Andrew Ferguson on Fox earlier today outlining the case. For more, we bring in Jen Reed, Bloomberg Intelligence Senior Analyst for Antitrust. She joins us here in the Bloomberg Interactive Brokers studio. I wanted to play that clip for you because it sounds like the case is about a couple different things, at least to the FTC chair. What is the case actually about? Because it sounded very political. And this is a case that has been a long time in the making that has spanned administrations.
Right. Well, it really is just about Facebook's acquisitions of Instagram and WhatsApp. Now, a long time ago, there were other allegations in the suit. They've all been thrown out. They're gone, having to do with not working with competitors. It's just these acquisitions. And the allegation is that for both of those companies, Facebook, at the time called Facebook and not Meta, was concerned that they would grow or be bought by a Google or somebody like some other big tech platform and become a real competitor to Facebook and give them a tough time in social networking. And so they bought them instead. It's sort of what they call a buy and bury, although they didn't bury, strategy. Yeah. And they're saying that just those acquisitions, that itself was anti-competitive conduct.
Hold on. Is that not allowed? Like, you know,
sounds like a business strategy to me.
You know, if you think about it, like, let's just think about it from the consumer packaged goods business. A large soda manufacturer going and buying a fast rising upstart that is making some sort of drink that a lot of people are seeming to enjoy. Is that anti-competitive?
So it isn't anti-competitive on its face, no. And first of all, it has
obviously
to do,
I'm not a lawyer.
Right, well, it has to do
are,
with a monopoly position. Do you have a monopoly, and have you done this to maintain your monopoly? That's the allegation here. So a company that isn't considered a monopolist, they can do something like that. The other thing is we're talking about buy and bury. So sometimes these things look anti-competitive where a dominant company buys up an upstart and then kills it. It's gone, which didn't happen here.
We've seen that.
Yes.
I'm not going to say who, but right, we've definitely seen that with various big tech companies.
Exactly.
That happens.
Right. We've seen it, but that isn't the case here, which I think makes this case a little bit difficult for the Federal Trade Commission because Facebook didn't just buy Instagram and WhatsApp and kill them off.
Right.
They put resources in and they improved companies that were really very nascent at the time that they were acquired.
But so the issue isn't, boy, this makes them even a bigger monopoly when it comes to the social world, or is that part of it as well?
Well, that is part of it.
Adding it on.
That is part of it, that they basically just maintained this monopoly they had in personal social networking and by just buying up everybody, they own them all. You know, they keep Facebook Blue, they call it the original, and Instagram separate. They're two different products, even though they're both owned by Meta, and that they maintain this monopoly over personal social networking. And what that results in is lack of choice for consumers, lack of quality. Maybe there's less privacy protections. There are more ads. Maybe if you had some competitor, you'd have better options as consumers. That's the allegation here.
Is that TikTok calling?
Good point. Very good point.
So what's at stake? Because Mark Zuckerberg already taking the stand in federal court today. What did we learn from any of that? I know it's all kind of happening in real time.
It is, right. He's really important here because there are two sides to this case that makes it very strange. There are a lot of documents, mostly by Zuckerberg, authored by him, or he contributed to in an email chain from 2012 and 2014 when these companies were bought, saying it's better to buy than compete. Right? This is bad. It looks like the intention is we don't want to compete. We just want to buy them up so that they won't be competing with us. But on the other hand, you have the situation where they put the money in, they built these companies up. And also, you have to prove as a plaintiff that it caused consumer harm. Maybe the intention was bad, and Mark Zuckerberg's going to have to explain away those documents and what he meant at the time. But even if they prove that the intention was bad at that time, they also have to prove that consumers were harmed. That is very difficult. Think about it. Many years ago, technology advances and changes very quickly. We have TikTok now. We didn't have TikTok then. YouTube has expanded since then.
Right.
So would we be in a better position had they not bought the companies? Those companies could be gone for all we know, or they could exist in some weakened form than they exist today. And how do you prove that consumers would be better off? And I think that's a big problem here.
Well, one last question real quickly, like 20 seconds. Might they potentially have to get rid of these?
That's what the FTC is seeking, and that's a big deal because about 50% of the ad revenue from Meta comes from Instagram.
Yeah, that changes the business dynamics. Jen, thank you so much.
Thank
Jennifer Rhee, she's Senior Antitrust Litigation Analyst here at Bloomberg Intelligence.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Focus on news out of Washington, D.C. and the president, especially when it comes to tariffs. The explosion and changing of tariff terms have led to a lot of volatility in global financial markets and a lot of questions about what's ahead in terms of the global macro outlook. It also risks adding to the inflation concerns here in the United States. Bottom line, it's a tough environment, as we heard this morning from Goldman Sachs CEO David Solomon on his earnings call with analysts.
This uncertainty around the path forward and fears over the potentially escalating effects of a trade war have created material risks to the U.S. and global economy. We are encouraged by the administration's recent actions to pursue a more gradual policy process that allows for considered negotiations with many countries. But how policies will evolve is still unknown.
Of course, that was Goldman's CEO, David Solomon, earlier this morning on that earnings call. Unknowns, uncertainties, not easy, any of it, for the Fed to determine monetary policy going forward. And as Bloomberg's Christine Harper writes in a Bloomberg opinion piece, looking back at former Fed Chair Paul Volcker's career could provide lessons for President Trump and his administration. Christine, by the way, is Bloomberg News editorial board member, co-author with Paul Volcker of the book about his life. It's entitled Keeping at It, The Quest for Sound Money and Good Government. Christine joins us here in studio. I said when you walked in, we've been thinking about you a lot because we've talked about Paul Volcker before with you in kind of stressful times and certainly these higher inflationary times. Paul Volcker, you write about 2 episodes during his life that are important. One takes us back to the administration of Richard Nixon in 1971. Go there with us.
Yeah, so he was a younger member of the Nixon administration. He was Undersecretary of Monetary Affairs, which he actually remembers as being the greatest job in the world. He loved it. But at that time, the U.S. had this unsustainable requirement that it honor this $35 per ounce price for gold. Mm-hmm. And at that point, after decades of overseas spending of dollars on, the Marshall Plan and various investments overseas, countries abroad had so many dollars that everybody kind of knew there wasn't really enough gold to back it all. And so it was up to the Nixon administration to sort of admit that and come out with an announcement. And it was a unilateral declaration on a Sunday night in August in 1971. Volcker was very involved in a whole weekend of talks about it at Camp David in the lead up. Everybody was surprised. It was known as the Nixon shock. And they recognized that suddenly taking the value of gold off of any kind of anchor meant that there could be just chaos, that the value of the dollar could plummet. So they put on all these wage and price controls at the same time. They created tariffs. They tried to do all these things to manage the fallout. And also, Volcker was immediately sent overseas to start talking to the financial leaders of every major country.
Sounds like an extensive plan.
There was an extensive plan. To be sure, like they weren't perfect. They did some crazy things.
Right.
They had the Treasury Secretary at the time, John Connolly, who only lasted for 18 months under Nixon, who was a sort of Texas, character, and he was a little nuts. But then George Shultz came along, and they had a much more focused sort of way of dealing with it. So it wasn't perfect, but it was, compared to what we're seeing with Trump and these tariffs, it was. There was a rationale to it that everybody could understand. There was real economic thinking behind it.
Mm-hmm. So that was 1971.
Yes.
Fast forward to 1979,
right,
when Volcker becomes Jimmy Carter's
Fed chair.
Yeah,
because the result of having no anchor to the dollar was that there was inflation. I mean, there were other reasons for the inflation and for the problems, but the value of the dollar was sinking. Inflation was incredibly high. It was destroying the American economy. And so Jimmy Carter brought in Paul Volcker, even though Volcker told him before, when he sort of was talked to for the job, I'm going to do whatever it takes to kill inflation. That might mean higher interest rates. It could be really bad for the economy. And Jimmy Carter chose him anyway. So it pretty much was one of the factors that sank Jimmy Carter's reelection, because the economy it was really tough. But it was successful at bringing down inflation, and the sort of Volcker commitment to price stability was so powerful, and so the integrity he had in pursuing that aim was so completely believable that from then on, instead of the gold standard, the dollar was known as being on the Volcker standard.
It's pretty wild. I mean, are we in the process of kind of losing that concept and idea?
So that was sort of the point I was making in my piece, was that, really what the Volcker standard amounts to is this belief that there are public servants in America, whether they're, appointed or political or civil servants, but who are going to do what's right for America and make sure there's price stability and make sure there's sort of economic rationale behind things. Of course, it's not always been perfect. There have been mistakes. But when there are crises, you see over and over again, these political figures will sort of retreat to the background and let experts, like, when George Bush was dealing with the financial crisis, it was really Hank Paulson and Bernanke who were handling it for America. But Bush wasn't kind of, back then there wasn't so much tweeting, but he wasn't like getting in the middle of it so much. And even when Bill Clinton was dealing with, the bond market turmoil, the beginning of his, he recognized that Bob Rubin had more expertise, and so we've had presidents that listen to economic experts. This feels different because really anybody who looks at what the administration put out has immediately mocked the
confidence certainly in the United States, right?
And I mean, when they saw the formula that was used to justify the tariffs, I mean, none of it makes sense. The various explanations coming out from the administrations contradict each other. So even if you think that the general idea of presenting a new trade order in the world makes sense, the way they're going about it is so haphazard that, as David Solomon was saying, like, nobody knows what's happening, and it's very hard to make any sort of forward planning.
Right.
As Carol mentioned, we're seeing this hit consumer confidence.
Yeah.
Going into this term, a question that we asked a lot of our guests, Christine, was, do we see maybe the markets, the bond market or the equity market or both, become checks to what the president is doing, at least when it comes to his economic agenda? In your view, did we see that happen last week?
Well, I'm not an expert on what's making the administration do anything, but
I don't think anybody is, except for the president himself.
I've just seen the reporting saying that Trump said, that the bond market was getting a little queasy, or whatever words he used.
I guess I'm just asking about guardrails here.
Yeah, I mean, the borrowing costs of the United States government is a huge guardrail. I mean, none of the administration's policies are going to succeed if suddenly we're paying a huge amount more in interest every year. So, you can cut as many federal jobs as you want. You can cut all the services from the federal government. But if all that, savings is overtaken by having to pay more on interest on our debt, I don't know where that's getting us.
What do you think the president could do in terms of, or he and his key economic advisors, to maintain the confidence in the U.S. by citizens of the U.S. and also the global world, based on what?
I think it does seem that a more consistent approach would be helpful. Yeah. That's what you hear from business leaders. That's what you hear from foreign leaders. They want to understand what the aims are here. They want a clear path forward, and not a daily change in the tariff regime and plans, and not sort of tariffs by tweet. That doesn't.
One thing I want to ask you: what if that's his aim, is to just constantly upset people and keep them kind of on edge, whether it's global leaders, whether he definitely has shown a deference to the equity market. It's certainly the bond market that caught his attention. But what if that is his strategy? What could be, as you think about, you've covered so much in terms of crises and just Madoff, crypto, so many things under your purview. How do you, how are we thinking about kind of the U.S. as an economic and financial might? Yeah, the U.S. is sort of based on this idea that your money is safe lending to the U.S. government. And if we have a policy that nobody understands or trusts and seems all to be designed to satisfy the whims of one person, it's going to be harder and harder for us to maintain that, and that would be really damaging for Americans. So ideally, what would be good to see, to say back to your question, is for the president to start listening to some of his. It does sound like Treasury Secretary Scott Bessent's taking sort of the lead on this. The markets certainly trust him a bit more. He's talked a lot more about a kind of a gradual approach, and so I think there's hope. That's why markets seem to be a little quieter today. That maybe some reason will prevail. The president is very impulsive, and so it's very hard to know what will really happen. Yeah.
What are potential long-term risks in your view if during this administration the U.S. moves away from this Volcker standard?
Right.
Does that have ramifications beyond the next election?
Well, sure. I think what you see is that the borrowing costs of the U.S. go up because people, whether it's American citizens or people overseas, just start putting their money, the money that they want to make sure is there no matter what. They're not necessarily going to put it in treasuries or all of it in treasuries. They might start finding other places. That's good for other countries and their debt or other markets, but it's bad for the U.S. borrowing. And you just see inflation caused because you'll have higher costs for Americans having to try to buy things overseas. I think there's just all these privileges Americans have gotten used to, knowing that the dollar was sort of needed by everybody in the world and sought after. And the same with U.S. Treasuries is at risk, I think. It's not going to go away immediately, but we've taken it for granted for a long time.
It feels like Jay Powell could find himself in a really complicated, right? In terms of if tariffs make things more expensive and there's more inflation pressures in what could be potentially a slowing growth environment. Yeah. That's tricky.
You saw that in the 70s after the Nixon shock. You saw basically these bouts of stagflation, and it was really hard. The Fed at the time wasn't able to deal with the inflation. They were too concerned about the slow growth, and they, basically Arthur Burns, the Fed chairman at the time, was a close political ally of Richard Nixon, and many people believe he just let inflation happen because he wanted to make sure Nixon could get reelected, and that turned out to be a really big problem for the U.S. economy.
25 seconds. If Paul Volcker was here, what would you want to ask him about this environment? Just quickly.
Well, I know he would. The big point he wanted to make in the book was the importance of competent government.
He was a true public servant, right?
Yeah, and so he realized sort of like the big takeaway at the end of his life was we need to have good, well-trained people staffing the U.S. government. So I think he would be really upset at all the ways we're treating federal workers.
All right, great stuff. Thank you so much. So appreciate it. Christine Harper, Bloomberg News editorial board member, co-author with Paul Volcker on the book, Keeping at It, The Quest for Sound Money and Good Government.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're talking Apple.
Yeah, this, after all, is the company that's most exposed to tariffs or a tit-for-tat with China when it comes to the Mag 7. Shares rallying, though, on that reprieve. We talk about the company's massive global supply chain a lot with our Mark Gurman, who's Bloomberg News managing editor for Global Tech. He joins us here in the Bloomberg Businessweek studio. You had a busy weekend.
Always. Yes.
I mean, but this is busier than usual. And I was struck by one of the pieces that I read that you wrote, which said Apple basically was able to avoid its biggest crisis since the pandemic back in 2020.
That's right. And I didn't listen to your full conversation with the prior guest. He's great. But if we're talking about Apple, I don't believe that they're going to be moving their supply chain to the U.S. Maybe it'll happen in our lifetime, but I don't think it's going to happen in the next 10 years.
What happens if tariffs on China continue to exist? There's no exemption for Apple. Can Apple satisfy U.S. customers through India? It seems to, by the way, it would seem to defeat the purpose of the tariffs, but...
Well, today, no. But I would say within a year or two, yes. Right now, they can probably fulfill maybe 75% of the U.S. demand they need in India. If they ramped up and burned the midnight oil for the next few months, they would probably be able to do it. But they would be able to do it pretty cleanly, I would think, in a year or two from now. They're already 30, 40, maybe a little bit more than that, million units. The U.S. represents probably 100 million units per year, maybe a little bit less. So less than rest of world. So, you're quickly getting there.
What does it do to the relationship, though, between Apple and China, if that ultimately is what it does?
Yeah, that's the elephant in the room, because China can't be too happy here. And I think the argument that Apple is trying to make is how important China is to the rest of the world, right? Still needing to produce 102 million iPhones. You're still producing all of those phones for the rest of the world. So basically the idea is splitting the supply chain in two. And again, Apple's supply chain goes well beyond the iPhone, but let's face it, what we really care about is the iPhone. The other stuff's cool, but this is where we're at. India's for US, China's for rest of the world, including China. It's pretty important still.
But again, it would defeat the purpose of the tariffs on China if you were to move.
That's the whole point.
That's the challenge I think Apple might face when it comes to dealing with the Trump administration.
Well, is it possible that Trump says, well, Apple is using India as sort of a lever here to get out of the tariffs? I'm going to put this huge new tariff on India also. That's a real question, right? And so I think that is what's making this so challenging for Apple, is that it kind of feels like whack-a-mole to some extent. If we're not going to just manufacture stuff in the US, we're going to have policies that are shifting, right, almost every day. We can have a president here who can, to your point, add an India tariff to a significant degree overnight, so they can put all their eggs in the India basket, and then, oh my God, we're going to have to move somewhere else now. We're actually going to have to move to the US. And so they've got a lot of cash. Maybe they're needing to start dipping into those cash reserves, whether it means to offset price hikes or to move something. But I just don't see the feasibility of moving to the US. It's just so unlikely. Let me just drop you a scenario here. I feel like, short of lying to Trump, if I'm Tim Cook and telling him we're going to move to the US, just give us a few years, and betting that Trump won't be back for a third term, right? Which obviously is not legal, but obviously they've been talking about it. I don't think it's going to happen. But anyways, the bet is that Trump's gone 3.5 years. They can tell Trump, this is going to take us 4 years, but we're going to get there because of you. So they can announce all this stuff, say they're going to do it, but never actually do it, knowing he's gone. That's one lever Tim Cook could pull. I don't know if they would do that. It's a risk, though. Well, because maybe you get Vance after Trump, and who knows what he does. But I think most people would understand these things take time, and there's no way you can move to the U.S. But I guess if I'm Apple, I could say we're going to do this and just not do it, and then come up with a reason 4 years why it didn't work out. One other thing, you could say we're going to move one component or one thing or packaging.
You talked about packaging with us last week.
Yeah, just come up with something.
Mark,
they may have to.
You talked about all their cash on the balance sheet. We always do. Can they survive 3.5 years of higher prices and deal with it and just ride it out?
Yes.
Okay.
Are they going to? No. Maybe actually. Do they want to? I think is what I was meaning to say. Absolutely not. But there's no scenario in which they're going to start charging $2,000 for these phones. They're going to eat some of it. Like I said, Apple, if it needs to happen, I would say it's a coin flip at this point if they're going to need to do this, but you're going to split it a few ways. You're going to split it between Apple eating it. You're going to split it consumer eating it. You're going to split it as the supplier eating it, right? And so we'll see what happens.
Fun times, right?
Not really.
No, I know. Sarcasm. Mark Gurman, thank you so much. Good to have you here in studio. Bloomberg News Managing Editor for Global Consumer Tech. Hey, when we come back, past as prologue, why the Trump administration may want to check out one former Fed chair's handling of matters. That's coming up on Bloomberg Businessweek Daily. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got about 18 minutes to go until we wrap up the trade on this Monday, April 4th. Carol Masser, Tim Stanovic live in our Bloomberg Interactive Broker studio. And bouncing around here in terms of the equity trade, I just heard the team breaking down the numbers. We're definitely off our lows of the session. Back up, but certainly on the S&P and the Dow near our highs of the session. That means up about 1.4% on the S&P 500. Dow Jones Industrial Average and the NASDAQ 100, both, Tim, up about 1.25%.
So we're back.
Yeah. I mean, it's an interesting kind of mellow day. And it's interesting to see green across the screen, which was highly expected.
After last night and what we saw over the weekend.
Well, because of what we saw over the weekend and stuff. And we definitely saw, I think, Asia overnight.
I don't know.
We saw some rallies. But
I'm still very confused by it. And I'm hoping Andrew Slimmon can help me see the light.
Let's see what he has to say.
He's Senior Portfolio Manager and Head of the Applied Equity Advisors team at Morgan Stanley Investment Management. He joins us from Chicago. Andrew, good to have you back on with us. The reason I say I'm surprised is because I think it's fair to say a lot of folks out there would say after this weekend, yes, there's this pause, but we still don't have clarity on what exactly is going to happen when it comes to trade and tariffs. Fair?
Absolutely. Thanks for having me on. But look, I think last Wednesday was a pivotal day because you can get growth scares where the market's down 15 up to almost 20%. That's a growth scare. But once the market gets past 20% down, the likelihood of recession is very high. And that's when the credit markets start to quake. And basically, President Trump came out and said, I don't like to see what I saw in the bond market. So I'm putting a delay on. So I think, in effect, what he did was he put a floor on equities. He didn't want them to go down more than 20%. And so, that's a growth scare. You can have a V bottom like we had in 2018 and 2020, or you can have a retest like we saw in 1998, 2011. 2022, you just don't know. But the point is sometimes you don't have a retest, and maybe this is one of those times.
Sometimes you do, sometimes you don't. I mean, isn't it safe to say, Andrew, that investors are still kind of struggling to game out what the scenario is and the economic spillovers of a trade war, even if it's maybe not at 145 or 125%? Many folks were saying even at 10% across the board tariff, I should say, from the United States against trading partners. It's a big deal. It changes the dynamics of certainly how you think about 100%. Companies, how you think about their earnings, and how you think about investments.
100%. But a lot of stocks are down a lot more than 10%. I mean, whatever the tariff impact, stocks are down. You've got some of these big Mag 7 stocks that were down over 30%. So a lot of bad news was priced into them. And I'm a big believer in watching kind of earnings and earnings revisions. But at times like this, I mean, I chuck that playbook because I don't think anyone knows. I read a research piece where someone, an analyst brought down their Apple estimates by 30%, and then they reduced that to only down 7%. No one knows. So the question becomes, what is embedded in stock prices? And there was a lot of bad news. So I think the market is rallying on the expectation, maybe it's not the worst scenario. I'm not pounding the table. I'm just saying, the answer to Tim's first question is, why is the market going up? I think, the news is slightly not as bad as it was, before last Wednesday, and the markets respond to positive rate of change.
Are you concerned about? Well, I don't know a good word for this, but it's like the idea that if you're an executive at a firm that's trying to make decisions about CapEx, trying to make decisions about hiring, and you really don't really know how much you're going to have to pay due to tariffs, there's this like paralysis that happens, I imagine. Do you think that's happening?
Yeah. Correct. My next question to you is, how much is the stock down?
Yeah.
Because if a stock isn't down much and that comes out, then I'm worried. If the stock's down a lot because the market anticipates paralysis, then I'm not as worried. So, yeah, I think there'll be a lot of that. But then the question is, what's the setup going into that, earnings number? I think the market anticipated that there will be this paralysis.
So is the market fairly pricing in the risk in your view?
Well, I mean, last Wednesday was, but we've had a heck of a rally here off the low, and the more you get a few more days, and I'm going to turn a little bit more cautious than I was. I wrote a piece last Tuesday that just said the playbook says down 15%.
What in your view changed? What in your view changed on Wednesday? Because Carol and I have been talking about this for the past few days. What changed on Wednesday? Yes, it's a 90-day reprieve, but still means that 85 days from now we're going to be talking about this again.
And now we're in limbo. Yeah.
My view changed because of what the president said. Very important. He didn't say, hey, we're putting a 90-day, reprieve on because, all these countries are coming forward. He said he's putting a reprieve on because he heard Jamie Dimon said chance of recession. He said he's putting a reprieve on because he didn't like what he saw in the bond market. That tells me he's watching the financial markets, right? He is watching it. So to me, that's what's changed. That's the key, is that he's not just, hey, we're just going to push forward and it's going to be pain out there, but it's all for the good. No.
Right.
He pivoted.
Andrew, have you ever been in like an Uber or a cab and they're like, foot on the gas, stop, foot on the gas, stop, foot on the gas, stop.
And I turn green.
And you turn green.
Well, so my point is, so he backs off, but we know he likes tariffs. The president's been very clear for years and years and years.
The most beautiful word in the English language is what he said to our editor-in-chief.
What that means, Carol, is the more the market goes up in this little bounce, the more he emboldens himself to not care about the market. So I think it goes back to this point of,
how do you invest in that environment, though, where he might be like, tariffs on? No, okay, market sells off, bond market gets crazy, tariffs off. How do you... CEOs are saying, I don't know how I make decisions. I don't know how I do things going forward. Like, how do you do stuff? Sorry, about 45 seconds left.
I think you invest when the market is down and you get a little bit more bearish when the market's up. You have to tack against the conventional wisdom. People were screaming scared after the market had dropped 17%. That's ridiculous. Likewise, to think it's all fine now, that's naive also. So my base view on the year is, look, it's a pause year. We've had 2 great years in a row for equities. The multiple got a little high. We're due for a pause year, but there'll be trading opportunities. I don't think this is the last time the market's going to drop like this. I just wouldn't chase it assuming everything's fine now.
We're still up 40. We're still
attacking against the headwinds.
We're still up 41% on the S&P 500 from the end of 2022.
It's great.
That's not so bad.
That's why we need a pause year.
Just don't look at your 401k right now.
Why
not?
It's
a little painful. Not doing it. Andrew, thank you so much. Andrew Slimmon, he is Senior Portfolio Manager at Morgan Stanley Investment Management, joining us from Chicago.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.